Welcome everybody. May 2 today. So entering the 5th month of the year, there's a lot going on. Today I want to share with you a little bit about real estate market tops that I believe we're going to see this year. I'll explain to you why I believe that, as well as some other headlines. So let me go ahead and just jump right in here. To get with the headlines, and again, as we go through this second week on the new platform, any questions that you have, please type them in the questions box on the right-hand side of the screen. I'll be monitoring that as we go through the material today. So that said, as I mentioned, real estate is the top here, is the leading headline I'll be talking about. Stocks had a very rough week last week and a rough month. And the director of the International Monetary Fund lets the truth slip out. I know that sounds cynical, but I'll talk about that in just a minute. And as real estate and stocks have, stocks especially, a rough week, commodity prices are continuing to surge. So this whole outcome of inflation followed by deflation that we've been talking about for a long time now seems to be playing out. Certainly, commodity prices are reflecting the inflation, and stocks are certainly reflecting debt excesses, and I believe real estate will soon follow suit. So that's what we're going to be talking about today. Starting with this article, U.S. pending home sales tumble for the 5th straight month as rates soar. That's interest rates, obviously, and mortgage applications plunge. This is from Wednesday of last week. After the unexpectedly large drops in new and existing home sales, analysts expected pending home sales also to fall in March, and they did, dropping 1.2% month over month, worse than the 1% drop expected, leaving pending home sales down 8.9% year over year. So about a 9% decline in home sales this year over the same period of time last year. This is the 5th straight month of declines for pending home sales, and it's right before mortgage rates started to explode higher. So keep in mind that when mortgage rates move higher, there's a bit of a time lag until that really affects the market. So I believe we haven't even seen that market effect at this point. This is the lowest pending home sales index since May of 2020, and the impact of higher rates have not yet been felt. The article says, just as we noted with the new and existing home sales, there's likely far more pain to come as mortgage rates surge. And this article shows you the relationship between pending home sales and mortgage rates. So I believe we're going to be seeing that affect this market a lot more moving ahead. Mortgage applications, meanwhile, have plunged. If you take a look at the blue line on this chart, it represents the pending home sales index, and the red line represents the mortgage applications. So you can see mortgage applications now are really lower than they've been since 2018. Bond manager Mark Kiesel, who's in the picture here, this comes from a Bloomberg article. Mr. Kiesel said that he believes that the mortgage, the increasing mortgage rates will negatively affect the market. He's got a pretty good track record. As the article said, he sold his home in California in 2006 when he predicted the housing bubble would pop. He bought back again in 2012 after prices of real estate fell 30% and finally found a floor. Now, Mr. Kiesel says it's time to sell again. Sky-high values, soaring interest rates, and other costs of home ownership, including maintenance, property taxes, and utilities, Mr. Kiesel thinks will dampen the prospects for future appreciation. Now, Kiesel is Chief Investment Officer for Pacific Investment Management Company, also known as PIMCO. He said, I'm thinking now about putting my house on the market. I'm going to rent for a while instead of own. He said he can look at his long-term 25-year charts. They tell me when to buy and sell, and they're flashing orange right now, meaning time to sell. He said, I think we're in the final innings, and I have thought that myself for probably a year or so. Home prices soared almost 20% in the 12 months through February, according to the S&P CoreLogic Case-Shiller Index. We had moves as a result of COVID. We had lower borrowing costs, low interest rates, and much inventory, which drove this market up at an artificially high rate. But now we've got the fastest rise in mortgage rates in decades because the Fed has to work to tamp down inflation. As a side note, as I've discussed, I believe that they probably will not be able to do that. But get this, the 30-year mortgage rate is now at a 12-year high. It's over 5%. And home sales contracts, which are a leading indicator, fell for the 5th consecutive month in March. So it started to fall in November of last year. And now we're seeing interest rates start to dramatically affect that. And again, I'll just remind you, if you have a question as we go through this, please go ahead and type it in the questions box on the right-hand side of the screen. And I am getting used to the platform. That is not a message. So I think, Mark, I have no questions. Please interrupt me if I do. So Kiesel is operating individually and not really as a representative of his company, PIMCO, because PIMCO put out a note predicting no bust after the boom. PIMCO said there's a shortage of houses, and that will mean that this housing market will continue to rise. That is likely not the case with rising interest rates, and PIMCO, being a bond fund, has experienced a rough couple months as well. The Bloomberg article points out that Kiesel's got a pretty good track record. He sold his Newport Beach house in 2006, calling housing the next NASDAQ bubble, and then home prices peaked later that year. So I believe that we're probably headed there again as well. In May of 2012, Kiesel bought a golf course adjacent home. And at that time, he said, if you're renting or you're on the sidelines, you might want to consider getting back in and buying a house. The future is hard to predict, but the U.S. housing market is healing and it's probably close to a bottom. Kiesel bought his house for $2.9 million in 2012. It's now worth an estimated $5.5 million. Kiesel said, if you buy a house today, you might see about a 2% return. So he doesn't like investing in a home. Now, keeping with the real estate theme, this article talks about the fact that the foreclosure avalanche has started. Well, we've seen stimulus money dry up. We've seen interest rates move higher. And foreclosures are up 181%. That's the highest level since March of 2020. The article says that in March of 2022, foreclosures surged 181% to the highest level since March of 2020. Chicago, New York, and Houston led the way. Some 8 months after a nationwide moratorium on foreclosures expired, foreclosure filings soared, and now they're at the highest level since the pandemic began. We've talked about the fact on the Headline Roundup webinars and on the podcast, as well as in the monthly newsletter, that moratoriums on payments don't solve the problem. They just kick the can down the road. Well, that's really what's happened as far as these moratorium on foreclosures. It doesn't do anything other than increase the amount of back payments that someone already behind in payments may need to make. And when the moratorium is lifted, the foreclosures start. And that's exactly what we said was going to happen. And that's exactly what we're seeing right now. Last month, 33,000 plus properties across the U.S. faced foreclosure. That's a 181% jump from a year ago. And it's a 29% jump from February. That's a big monthly jump. The first quarter saw 78,000 plus properties with a foreclosure filing. And that's up 132% from last year. So this is the highest number of foreclosures since March of 2020. And I believe you're going to see this probably continue to accelerate as well. August foreclosures jumped 27% after the federal moratorium expires. March was the 11th consecutive month in which foreclosure activity posted a year-over-year increase. Not only did foreclosure activity hit a peak, the time it took properties to foreclose ticked down a bit, down 3% from the prior quarter. So foreclosures are happening more quickly, and there are more of them, and this, I believe, will impact the real estate market as well. Now, California had the highest number of foreclosure starts, 5,378. Florida and Texas took second and third. Chicago saw the greatest jump in new filings in the first quarter of 2022, and New York was close behind them. Now, Wolf Richter commented on this as well, and the bottom line here, and the reason I'm bringing this up is that if you're thinking about selling your home, now is probably a really good time to do that. If you're thinking about buying, if you can afford to and you're willing to sit on the sidelines, it's probably a really good time to not jump in. Now, Wolf Richter, whose work I follow, and I would advise you to go take a look at this article as well, had this headline: the most splendid housing bubbles in America. April update, raging mania on the eve of the spike in mortgage rates. Home prices spiked in crazy leaps, including by about 30% or more in Phoenix, Tampa, and Miami year over year. But this raging mania took place with mortgage rates of late last year, given the long lag of the Case-Shiller index. And this is referring, as I just did, to the lag between interest rates increasing and the negative effect it will have on the housing market. So Richter's commenting on this as well. The home price data released today was called February and represents the 3-month average of closed sales that were entered into public records in December, January, and February. It's important to remember that this data reflects deals that were agreed to prior to that, because from the time an offer is accepted on a home until the time that home actually sells or closes, there is a time lag. Richter makes a really good point here as well. A lot of these home buyers were pre-approved and had rate locks. In November and December last year, the average 30-year fixed rate was at about just over 3%. So that's when a lot of these home buyers got rate locks at a 3% level. Now, that is represented by the green circle on this chart. If I go back one slide, there's the green circle representing the average 30-year rate that's really impacting the mortgage and how home sales data today. Notice that it's still at a very low level. Now look at what's happened since to interest rates. They've gone up in a parabolic manner. From December of last year to April of this year, we've gone from about 3.2% to about 5.2%. We haven't seen this level since prior to 2018. It's a 12-year high, as we talked about in a prior article. So Richter points out that the home price data in the charts, and we're going to look at some of these in a second, doesn't reflect any of this mortgage rate spike. The effect of that is still coming. What this data represents is everybody who was in a panic to buy homes while they still had the rate lock and rates were low. In fact, I read another piece that the requests now for adjustable rate mortgages are much higher, given that we've seen a spike in interest rates. So the pendulum is starting to swing back the other way. So Richter points out that there was this mad scramble. Everybody wanted to get their deal done before mortgage rates went up. And now we've seen this rate spike, and we're likely going to see that impact housing moving ahead. Now, I thought these charts were especially interesting. So I didn't put them all in here. You can go take a look at the article, but I just pulled out a few from some of the major real estate markets. So if you take a look at the San Diego market, Richter writes that prices of single-family houses in San Diego spiked by a holy moly 4.5% in February from the prior month, and 29.1% year over year. I mean, we all know that the price of assets, the value of assets don't increase 30% each year for multiple years in a row. And if you look at that chart, Richter points out that the index value is now 401. In January of 2000, 22 years ago, the index was at 100. So housing prices in San Diego have increased 400% since 2000. What I think is really interesting, though, is comparing housing prices in San Diego today to at the time of the prior housing bubble. And they're labeled on this chart Housing Bubble 1 and Housing Bubble 2. Housing Bubble 1, that index got to about 250. It's now at about 400. I've pointed out in the past that the low in interest rates in the prior housing bubble was 5.75%, 5.5% maybe. Well, we saw interest rates that haven't even gotten back to where they were today at the time of the housing bubbles. In other words, interest rates at 5.2% are still below where they were at the low point in housing bubble 1. I think if you just consider that, housing prices and stocks could have a lot way to go down here. Now, if you look at the Los Angeles metro market, prices up 22.1% year over year. Index value, 397. That's up almost 400% and certainly up a lot from the last housing bubble. Seattle, 26.6% year over year. And again, look at the comparison on the chart on the left here as to where housing prices peaked during housing bubble 1 and where they are today. San Francisco, same thing, year over year, 22.9%, up 3.7% for the month. And you can see that all these charts are really topping in a parabolic manner. Miami up 29.7% year over year. A lot more of a spike than they was during housing bubble 1. And back in the housing bubble 1, everybody was saying everybody wants to move to Florida. These prices can't go down, but they did. And I expect we'll see the same thing again. Tampa, 32.6% year over year. If you're thinking about buying a house in Florida, I think now is probably not the time to do that. And again, as we go through the material today, if you have any questions at all, go ahead and type those in the type your comment box or the question box on the right-hand side of the chart. And Mark, I just want to make sure I'm not missing questions here since we're on a new platform. Am I good to keep going here?
You are good. No questions yet.
Okay, thank you. So stocks, if you have been watching stocks and did watch them during the month of April, it was a rough month to be in stocks. This is a headline from an article that I found. There were many describing what happened. U.S. stocks crater as the Dow sheds 939 points and the NASDAQ notches its worst month since 2008. And we know what happened in 2008. That's when the stock market decline accelerated. And if the Fed continues to talk about tapering, I would not be surprised that we'll see something similar happen here as we have been discussing. For the last year or so, we've been talking about the Buffett indicator, which measures the value of stocks by taking total market capitalization and dividing by total economic output. It was really extended. It's still extended, but we are now seeing stocks react as we expected that they might. The article says U.S. stocks fell Friday as each of the three major indexes capped off losing months. The tech-heavy NASDAQ closed out its worst performing month since 2008, shedding more than 3% for the day as investors fled the e-commerce giant after downbeat earnings. Netflix is getting absolutely decimated. A lot of tech stocks are getting beat up. Bank of America decided they maybe were a little bit too optimistic. They were calling for 4,600 on the S&P by year end. They now said, no, we're going to see 4,500. I would expect something lower if I were handicapping the market, although predicting where the market ends up is a sure way to be wrong. Bank of America analysts said that there's a 1 in 3 chance the U.S. economy will enter a recession. I expect that a recession is probably here now. Kathy Wood's ARC innovation, which was a big headline getter because it was making huge gains on the way up, is now making headlines because the innovation fund is absolutely getting hammered, despite Ms. Wood's insistence that tech stocks still have a long way to go. I talked about this on a prior webinar. Zoom and Teladoc, Zillow are all companies that ARC Innovation owned. Many of them had never turned a profit, and you can't change the economic fundamentals in that. If you have a company, the company has to be profitable in order for the company to exist. And these companies have had rabid investors buying them, anticipating that the companies would grow into profits. But like at the time of the tech stock bubble, that has not happened. Zoom and Teladoc are the pets.com of the tech stock bubble, which I've talked about in the past. Wood's Innovation Fund is down 29% in April. That means it's down 70% from its record high in 2021. That will return to its real value, and I expect more downside here as well. And the next thing I want to talk about is the International Monetary Fund director lets the truth slip out. This is a little bit tongue-in-cheek, but I don't believe it was an intended comment. Michael Maharrey, who writes for Shift Gold, a past guest on the radio program, had this piece. And he wrote that also really from a bit of a cynical perspective, said mostly we get lies, spin, and obfuscation from the central bankers, politicians, and bureaucrats, but every once in a while, we accidentally see one of these people wander into the truth. IMF Director Kristalina Georgieva did just that during a recent panel discussion hosted by CNBC. She conceded that central banks globally, quote, printed too much money and didn't think of unintended consequences. That is a very honest statement. Here is what she said. I think we are not paying sufficient attention to the law of unintended consequences. We take decisions with an objective in mind and rarely think through what may happen that is not our objective. And then we wrestle with the impact of it. Take any decision that's a massive decision, like the decision that we need to spend to support the economy. At that time, we did recognize that maybe too much money in circulation and too few goods, but didn't really think through the consequence in a way that upfront would have informed us better what we do. Well, Maharrey makes a really good point. How this economic brain trust failed to consider that injecting trillions into the economy would cause prices to rise is a bit of a head scratcher. I mean, we all know that. We all knew that when you create a lot of currency out of thin air, it's going to go somewhere and we're going to get inflation. And that's exactly what has happened. He said, how did we all know this? And the people charged with running the global economy, how did they miss it? He said they're either wildly incompetent or they're simply not telling the truth. Frederick Bastiat said that they're bad economists, and here's how it was defined. Between a good and a bad economist, this constitutes the whole difference. The one takes into account of the visible effect, the other takes account both of the effects which are seen and also those which it is necessary to foresee. So Maharrey makes a great point. He said, either way, these are bad economists. Good on Georgieva, I guess. They say admitting your problem is the first step on the road to recovery. So maybe you think this confession is a step forward, but I assure you it is not. He said, these people think they can micromanage the global economy because they've got ego and they're arrogant. They think they need to just try a little bit harder. Georgieva admits the mistake, but Maharrey points out that when you look at what else she said, it seems she hasn't learned the lesson. She said, quote, we act sometimes like 8 years old playing soccer. Here's the ball, we are at the ball, and we don't cover the rest of the field. Our ability to deal with more than one crisis at a time is very, very limited. We have to zero in on the really big things that could determine the future and keep our attention on them. I've expected since day one that unless governments operate with a balanced budget, we will continue to see currency creation and inflation. And these comments from Georgieva seems to validate that opinion. We'll just have to wait and see. Mahari says of Georgieva's comments, she's basically saying, oops, our bad, we messed up because we didn't consider the unintended consequences, but don't worry, we're going to do better next time because now we're going to focus. Georgieva, Powell, Biden, Lagarde, and the whole lot of these central planners don't understand that it's impossible for them to take into account all the unintended consequences of a given policy prescription. That's why central planning is always doomed to failure. And I would certainly agree with that. F.A. Hayek, he's got a couple terrific books that I have read. Serfdom is especially appropriate, and if you haven't read it, I would encourage you to do that. But Hayek concluded that central planning will always fail because it's impossible for the central planners to process all the information necessary to factor in all the ramifications of any given policy. He said the knowledge of the circumstances of which we must make use never exists in concentrated or integrated form, but solely as the dispersed bits of incomplete and frequently contradictory knowledge which all the separate individuals possess. And finally, and again, if you have a question, I'm not seeing any, but you can type it in the type your comment box. Commodity prices continue to surge. Spring wheat used in pizza crust nears a 14-year high as floods devastate northern plains. Now, there's always a weather reason given for rising agricultural commodity prices. However, primarily, it's due to currency creation. U.S. spring wheat futures are nearing the highest level since 2008. Talks about blizzards, winter storms, high winds, and extreme flooding battering the Dakotas, meaning that plantings didn't get in on time, and raising concerns that crop yields will be lower. Now, not to mention the fact that input costs due to inflation for corn crops are up 300 to 400% from the farmers that I've talked to, meaning that many farmers did not plant their normal traditional crops. I would expect that this will mean much higher prices by fall. I don't expect that we've seen the end of this either. The most active spring wheat futures contract increased more than 1% to over $12 a bushel. That's March's peak and is closing in on the highest levels since 2008. And just take a look at this chart going back to 2020 on wheat prices. I mean, at the end of 2020, wheat was under $6 a bushel. Now it's 12. Wheat prices have doubled. Now, spring wheat is used in specialty items like pizza crust, bagels, croissants, and rolls. And then the Russia-Ukraine situation is also impacting production. Again, there's a time lag here. This is an input that's used in all these items that I just mentioned. We won't see that impact it for a bit until a bit of time has passed. Corn doing the same thing. We're starting to see $8 corn. Cash corn prices hit $8 or higher in 205 places on the DTN National Corn Index spot bid map. Basis levels in the corn needy areas of the United States has remained strong as the short supply of old crop corn is in a tug of war between ethanol plants and feeders and recently the Gulf. So there's a lot more demand for corn than there is farmers actually producing corn. And I expect that you'll see even higher corn prices moving ahead as well. So that's what I have to talk about today. We have just a couple minutes left here, about a minute left. We've got our half hour in. If you have a question, type it in the type your comment box. I think I'm seeing a question here. Gold is getting, Mark, I can't see who this question is from, but.
From Jeff Miller.
Oh, okay, Jeff. Gold is getting pummeled today and has been soft for weeks. Is this a manipulated move or an indication of a softer economy going forward or something else altogether? Great question. Jeff, I think what you're seeing here is a fair amount of price manipulation. The gold market and silver markets are both highly leveraged. I expect that you will ultimately see gold move much higher. I think that technically speaking, gold is very near what I would consider to be a low here. I have not had a chance to look at where it is today, but that 1850 to 1870 range, I would view as a technical bottom. So my crystal ball doesn't work all the time here either, Jeff, but of all the assets that you can have money in moving ahead, I like tangible assets and remain bullish on gold and silver. And I would view this as a counter trend move here. So that'd be my take. And if you have another question, I'd be very glad to hang out here a minute.
William has a question.
Mark, I'm not seeing the question, so why don't you just go ahead and
Sure, no problem. So risk regarding housing prices, do you see the low coming to still be higher or lower than the low from the earlier housing bubble?
Well, I would be 100% speculating if I were to guess there. I expect that we're going to see housing prices decline in a big way. If you take a look at the chart, looking at housing prices, you can go back and look at this again. The chart's parabolic, and I would expect that, in fact, maybe I can go back to one of these charts here as I answer the question for William. Here we go. Let's just look at, here's Miami. If you take a look at this bubble, you can see that that bubble started to build. I'm looking at the Miami housing bubble starting in about 2003. And Mark, on this platform, can you see the cursor or can you not?
Yes.
Okay, so my cursor here shows about when that bubble started. And then this shows you about where the bubble unwound. Notice that bubbles tend to be pretty parabolic and symmetrical in nature. So they tend to take about as long to unwind as they build, and they tend to be a mirror image of each other if you were to draw a line through the top of the bubble. And I think that's evident when you look through all these bubbles. So that suggests that a couple things could happen. The most recent parabolic move would get us back to this 260 level on the Miami, down from 360. So that would suggest about a 30% decline in housing prices in Miami and other places that I think could happen fairly quickly. This bubble actually started to build again about the time the Fed began quantitative easing. So at this bottom in 2011, that's about when the Fed started this temporary program of quantitative easing. So if you look at this housing bubble, it's interesting because from 2011 to about 2020, the rise in housing prices really reflects the level of quantitative easing that the Fed was doing. Now look what happened in 2020 when the Fed's currency creation went off the charts. We then have this bubble go completely parabolic. So I think we're going to see a fairly quick move back down to that 260 level, and then I think it might take a little bit longer to unwind. And of course, the caveat here is, what is the Fed going to do? I still happen to believe that they're going to react by creating more currency, stating that we've got to prop up the economy, we've got to support housing, we've got to support stocks, but I don't think it's going to work. At least I don't think it can work more than one more time, but I would bet on it not working. So when you look at these bubbles, they tend to be very congruent with, very symmetrical with the way the Fed has created currencies. So I hope that helps, William, and gives you some ideas to where I think it could go. But the reality here is we really don't know what the Fed's reaction is going to be. So I hope that answers the question. Appreciate the feedback last week on the new platform. We are still getting used to it. Appreciate, Mark, your help in getting the questions out there. And we will be back again live next week. So have a great week.